You to write down the following words. If you got a pen and paper, please get a pen and paper or put it somewhere that you can memorize it. This helped me a lot in trading. What, why, what, where, when and why. Again, what, where, when and why. And I will explain that to you and how I use those 4 words. If I look at the market, I want to know if I want to buy or sell. That is my what. What do I want to do with this market? Do I want to buy or what do I want to sell? Second question that I must ask myself, where do I want to sell? Alright? Where do I want to sell? When do I want to sell? Obviously then I will enter my trade, and if I can then answer those 3 words, I've got my why. Alright. So let's go to a specific currency pair and see what are we going to do with it. Alright, let's look at the New Zealand dollar 15 minutes. Let's go. Let's clear this chart and let's go see if those 4 words can help us. Alright, so what do I want to do with this market? This is a monthly chart. I can see it from the top here. It broke down. There's big resistance there. Alright, so that's the top of my chart and I see all the spaces down here. Alright, so what do I want to do with this market? First answer that I want to give myself, I want to sell this market. Why? Because for the last few months this market is extremely bearish. I want to trade with a trend. Even if I go down to my daily, I can see a strong downward move. I don't want to buy this market. There's nothing going on here. You see it's resistance, broke down. There's a lot of space down here. If I can mark that space here, look at that space there against this space up here. Alright, you see all the spaces down here, small space. So I want to sell that market. That is my what. Second question, what I want to do is what and where. Where and when. Right, the market came down. There's a little bit of noise here or sideways movement. It break down again. If this was my support down here, I wanted to sell that support. And why is then I'm in a bear market. It broke support. And I've got reason to stay in this trade. I'm still going down. There's no reason that you want to buy this market. Alright, so that's just a basic principle. Those 4 words will help you in trading. I'm going to go a little bit further. You can post your questions if you have some. We all know we must trade with a trend. Selling in a bear market or a downwards movement, and we want to buy in an upwards movement. We will go in that a little bit more with indicators, where we want to buy everything. I just want to know where you guys at. What do you have any questions? Do you understand everything? If you know nothing, you're going to get behind. So please stop me if you don't understand what I'm saying. If you've got no experience in FX at all, I will stop and I will go a little bit slower. This is a basic lesson, so let's quickly there. Nothing at all. Are you still guys there? Still there? Alright, let's go on. One of the trades George did a few months ago, he did it with a previous webinar as well, was the Euro CAD or the Euro Aussie. Just want to check which one is it. Euro CAD. Right. This is it. Alright, so look at this example. We've got a bear market here. So what is our what? We want to sell this market. Where do you want to sell it? In the fib zone is your answer here. And when do you want to sell it? I want to sell it when the market turns at a Fibonacci. So we've got our downwards movement here. That's an impulse move. That's got 5 moves. I'm going to tell you now how I count my waves with the Elliott wave. I will do that in a lesson next week or so. This is a 5-wave move or an impulse wave. You can look at the videos I did before with the corrective waves and the motive waves. That a corrective wave has 3 waves and an impulse wave is in 5 waves. We want to trade in the direction of the trend or in the direction of a 5-wave move. Alright, can you see the 5-wave move on this chart? Let's move that down here. I'm going to draw in some trend lines just to show you how I count these waves. There's my first, second, third, 4. So there's 5 swings. 1, 2, 3, 4, 5 waves. There was a little bit of divergence of the RSI, and this then retraced. I've got a 5-wave move. If I put my Fibonacci's in, I saw this market at the 618. George did it before. I'm just recapping it quickly. There was a pin bar or a shooting star or a doji on the 618. I want to sell that market. There at the 618, that is my why and where. And the market came there and it fell down. Look at this RSI. A lot of strength here above the 70. We know that market is going to turn. And the market fell. Alright. So in trading, we want to trade with a trend, not against it. We want to trade against a corrective move, and we want to trade with a trend. Guys, you must help me here. I'm just going on with the lesson. I just need some participation. In other words, I need questions to know what you guys want. If you are still online, if you can still hear me. It's the sad part of this webinars. We don't know when we're going offline. We're talking for like 10 or 15 minutes and we're talking to ourselves. So let's make this like this is a participant webinar. A lot of questions. I like questions. Alright, Ian, you see that's alright. You're back now. Guys, are you in again? Can everybody hear me? Alright, line is very bad. It's not the best of weather in Cape Town, so it's a little bit of overcast. The rain is coming down, so maybe that is a thing, but I'll let Telkom come and test the line again. If it's on this side, we'll fix it in the following week or so. Otherwise, it's just on your side. You can just tell me. Alright, so you're all still here. Alright, Bongani, welcome. You also joined us. Alright, there's another user. Okay. I'm going on, guys, I'm going to the majors. I'm going to start with the euro. Everybody's trading the euro. Do you know how a triangle works, everybody? Do you know that a triangle is a trend continuation pattern? I'm going to work with patterns and I'm going to show you the head and shoulder. Everybody is aware of the head and shoulder pattern. That's a very basic pattern in FX. I think most of our traders missed this very nice head and shoulder pattern the other day on gold. This is gold monthly chart and I'm going to show you why. Nobody saw this head and shoulder pattern. Can you see it? Gonna show you how it works. Alright, the market came down here and made an, if you want to call it a skew head and shoulder, you can call it that, or you can call it a head and shoulder with a neckline that is not equal. I'm going to tell you the rules of a head and shoulder, where we trade it, how we trade it. It's an 80% successful pattern in the market, but we must stick to the rules. Alright, this is a basic head and shoulder pattern. We've got a low, we've got a lower low, and then we've got a higher low. We've got the neckline then, and then perfect rules of the head and shoulder. You can write this down. There's no other way that you can trade a head and shoulder pattern. You can only trade it as long as the neckline is broken. When the neckline breaks, then you trade this pattern. You don't buy the right shoulder, and I will show you why not. You buy when the neckline breaks. Alright? And your target is from the head to the neckline. You take that as your target. Alright, so this is not met our target yet. Our target is 1330. I believe this market, and I'm ready to buy gold at this moment just on this pattern. Alright, there's the head and shoulders again. I'm buying the market when the neckline is broken, or when the neckline breaks, and my target is the same length from the head to the neckline. From the neckline will be then my target. Jan, you're still with me, everybody? Gold is still bullish for me. And I'm going to tell you, does anybody know Fibonacci's? This is what I put in. It's just a, let's call it a freebie. One of my trades that I'm looking for in the next session or two. I want to buy on the 38.2%, and I'm going for 1332. Alright, so I'm calling a trade now. The guys want to follow that. Ian, I don't want to buy at the current price. No, I'm looking for a pullback. There's a lot of reason why. You can see this red line here. I'm going to make it other color. I've got a lot of colors on this chart now. So let's change that to a dark blue, and I'm going to make it a little bit thicker. I only use one moving average. I use the 200-day moving average only on my daily. I want the price now to come back to this 200-day moving average. You will see it's exactly on my Fibonacci at the 38.2%. We call it Confluence with a moving average. I want to buy that market, and I'm going to 1332. Alright, so buy gold about 1255, 1260, and we're going for 1330. That is what I'm looking for. Obviously, guys, you can't just, when the market goes down, buy. We need some information here before we can buy. I'm looking for a bounce. The guys that know supply and demand levels will also know that this is a very nice supply level here. That level there, that is a lot of supply, so I'm looking for that market to touch there. On the 38.2%, I'm looking for my indicators to show me that it's oversold, and then some other candle information. I will buy the gold down here. Alright, so let's go through our 4 words. What I want to do with this market, I want to buy. Why do I want to buy this market? Because gold, you can see it's very bullish, so the market's going up. I don't want to sell that market. The only place that I would look for a sell, even if it's 1340, but that's against the resistance there. That's the only price that I will look at sell. Because the market is bullish, because this is the inverse head and shoulder, it's bullish, I want to buy this market rather than buy. So that is my what. Where do I want to buy it? I want to buy it on the confluence of the 200-day moving average and the 38.2%. Alright, when? As soon as I touch it with the candle information, and as soon as I enter that trade, I put my stops in. I will put it at 1,200 or 1,210, and now I've got my why. I know the reason why I've entered this trade. If you're in a situation where you entered the market and you don't know why, or you can't answer the reason why you have bought or sold that market, you're in trouble. The fourth why is very, very important. You know you can stick with that trade. Either it's going to hit your target limit or it's going to hit your stop. We must know why we enter the market. And those three questions did that for us. Alright? Some other markets I'm looking for. Guys, very important. In trading, we don't predict. We trade confirmations. The biggest thing that traders do, the biggest mistake that traders do, they want to predict a turn. The market is bullish, there's some candle information, this market is going to turn, and they want to sell that market. That's the worst thing you can do in trading, and that is the quickest way you will wipe your account. We don't predict in this market. We wait until the price shows us in which direction it wants to go. In this market, we know it is bullish. I will look there. I've got all my technical analysis done. I know what I want to do. I see there's a lot of stuff going on here, but I won't buy that market until the market tells me that it is turning. Either by a bounce with a candle information, then I will look at my RSI and my stochastics. So the market is telling me that it is turning, then I will buy. Alright? Very important. The biggest mistake, again, that traders do is they want to predict the market, they want to predict a turn, and that is the quickest way that you can burn your account. I also said last week on the Trader Lounge that I suggest everybody, or it's my suggestion, you don't have to do it, but me personally, I've deleted all the Swiss franc charts off my computer. I don't have it until the end of this year maybe. There's no trend, guys. The Swiss bank took off the peg on the interest rate. There's no technical analysis what will make sense, at least on a 30-minute, 1 hour, 4 hour chart. Maybe you can see what is going on. You can trade off that, but that's a very, very bad place to be in. That is totally a fundamental thing that happened last week. We all read that FXCM got bailed out with $300 million. They took a loss of $2 to $5 million. So many brokers went bankrupt, and I know many traders lost 50% of their accounts. So me personally, I don't do Swiss franc at the moment. I need a trend. I need patterns to show me in which direction it goes in the next 12 months or so. Alright? Any questions, guys? I want to show you the difference between corrective moves and impulse moves. Bongani, Ian, Polo, can you still hear me? Any questions, guys? I'm going slowly. Is there any indicators that you want me to do now? Show it how it works. I'm going to show you a trick. 2 indicators that will help you to, let's do stop placements. We know in enter the market when using Fibonacci. Alright, do you want me to do Fibonacci? I will do that for you gladly. I'm on this Australian dollars New Zealand, so let's do that again. Alright. Okay, Fibonacci is hidden support and resistance levels where the market can turn, or we suspect the market can turn. It's very very nice to use. We all know that the highs is resistance zones and the lows are support zones, Bongani, but hidden support and resistance is shown by Fibonacci. Alright, let's do that. Yeah, I will do next week. I'll do the principal waves, the Elliott wave principle, how to count waves, what the targets are, and this is just basically to cover all the groundwork of trading, trade with a trend, how triangles work. And then next week I want to do a whole series of Elliott wave principle. I will do principle here. You can see at the euro here, Elliott wave principle. I did here very nice, and I think the euro is still going down to below 110, 108. Yes, I've got a book, Elliott wave principle. Prechter is the author there, and it's very nice. But you can go on Google, go look at Elliott wave principle, go look at videos. I will show you next week how you count waves and what's the targets. It's a very, very nice thing to have. But let's do Fibonacci quickly, Bongani. Alright, let's look at the Aussie dollar here. Just want to delete all this stuff. So that we can work. Alright, Bongani, you know that this is a bull market. We can draw our trend line here over the lows. Alright, I'm going to start very basic. We've got a bull market. We know the trend line is at the bottom. And because it's a bull market, our trend line must go up. And now we want to draw in Fibonacci's, and we want to know supply and demand levels. Supply and demand levels are not the same as support and resistance. I will show you supply and demand levels just in a minute, how I look at it, and we're going to do Fibonacci first. So basically you can see there is a cycle here of 1, 2, 3 swings. Alright, 1, 2, 3 swings. This is my first swing, because we're at the bottom here. We take my Fibonacci from the bottom to the high there, that first high, and we see the market came down here almost to the 78.6% in the fib zone, the 618. So the market had a rally, came back, and it bounced almost at the Fibonacci level there. Looking at the second swing, we take that low there at the bottom, this one here, till that high here, and we see the market is now at the 618%. Alright, 618%, that is the fib zone. There's a few other things that must be in line before I can buy this market. Remember, although we are looking in a bullish market here long term, this is a monthly chart. Although the market is at 618, we only got 3 Fibonacci. I put in the fourth one, the 78.6%, and I will tell you now why. Most of the traders now want to buy this Aussie dollar going long, because they say the market is at the 618% or 618 support. That is not the case for me. I will not look at this market to buy if this market doesn't tell me that it's turning. Alright, through the 382%, you see there's a little bit of movement here on the 50%, but it broke through. Now testing the 618%. It broke through, but it's coming back now. Alright. Supply and demand levels is something totally different. It is a specific pattern in the candles that that I see that helps me to know where the buyers and sellers are. I'm looking for a nice supply and demand level now to show you the difference. Look at this CAD quickly. We've got a down run here. So I'm taking this fib, alright, taking it from the high to the low because the down market, and I see the 618% is on that yellow line. I've marked it there. That's the only place that I want to sell the Australian Canadian dollar. Maybe I'll sell it there. This is a bullish market. You will see the last few weeks. This is extremely bullish. There's no way you can sell this market. We want to buy in the direction of the trend, or we want to sell when the market is turning. Alright, so that Fibonacci level there at 1.33 on the Canadian dollar shows me there's maybe a hidden sellers there. Yes, supply levels is buyers. So they are supplying us with that currency. Everybody is buying. And a demand of sellers, okay, and the demand level at the bottom, there's a lot of demand, so everybody is buying, and supplying, everybody is selling. Alright, so they apply with us, to us, we are selling. I'm looking for a nice, let me see here, I'm going to show you guys how supply and demand level looks. I'm going to go through my charts quickly to see if I can pick up something. The difference between resistance and supply and demand. Supply and demand levels, Ian and everybody, is where there is market, what do you want to call it? There's more than the other. So the market is sideways, and then suddenly the bulls win and they break out, or suddenly the market is sideways and the sellers. So you know that is a supply and demand level. Quickly, there was one on the yen yesterday. Alright, look what happened here on the New Zealand dollar, or Japanese yen, sorry. Can you see the market is coming? This is only a 15 minutes. You can see it on every price chart. We came down here and the market was bearish. There's a long bearish candle. We went sideways for 2 candles and the market broke again. Alright, many will call that the morning star. That is true. This is a drop with a base and a rally. Now the opening price or the closing price, the top of that candle, that little red area there, that is my demand level. This is a demand level. My entry this morning was on 117.40 because my supply level is there. It just missed me and it rallied. It just went without me. There was one on the pound the other day when the fundamental came out. I want to show you guys this very, very nice supply and demand level that I use. You must go look in the market in the next week or so. Let's do this a lesson on supply and demand levels. This is a very specific, this is only for scalping, and I'm going to show you how it works. You see the market turns here. Alright, there's my turn. Right. Market made a turn there. That's a high. Look at that black candle. We've got a doji next to it and then another strong breakout. Right, that to me is my supply level. I mark it. That is a very specific candle pattern that I use. Mark it with yellow and look what happened. The market came down and just tested that supply level. Tested there again, tested there again. There was a fundamental last week. Look here at the bottom. The market turned here. There's a nice white candle with a little bit of a doji and then a breakout. Okay, so immediately I see that as a possible demand level again. I marked it and look here how the market touched and it shot up. Tested that supply level there. You can put your stops below the low there. Obviously we took that trade, we went out with a profit. Guys, this is really a 30-40 pip trade, not more. And as soon as you got 30 or 40, 50 pips out of it, even on a 1 hour, then you're out of that trade. That is just basically testing supply and demand levels on a very, very small time scale. I don't like it on the smaller time frames. I like it on, yes, I will place pending orders. That's the only way that you trade. Sometimes I'm in front of the PC or in front of the charts, then I will do a demand and supply level. Look at the New Zealand dollar monthly. We can look at this market. It's still a far way off, guys, but look at the market here. Look at the bottom, a strong white candle, a sideways candle, only one, and then it shot up again. So I will do that, and I will mark that as a possible supply level. Alright, I know that there's a lot of indecision in the market there, and the bulls broke out. So all the bulls are in favor of this market there. There was a lot of noise there, and if I put in my Fibonacci from the bottom to the top, I will see it's very close to the 78.6%. That's my last Fibonacci. I will look at this market to buy here, but that's very, guys, this is still years off maybe. And I will put in a trend line there. If this market comes down fast, I will look to buy opportunity. But that is just an indication how supply and demand levels. That is a rally base rally, and the other one that I showed you was a rally base, and then drop. Alright, let's do triangle quickly. Guys, if you do Elliott wave principle, you know that the triangle is a trend continuation pattern, and it can only happen in the fourth position or the B wave, the fourth wave or the B wave. If you also work with Fibonacci, here's a very, very nice tool that you can have. When the market turns, it will have a deep retracement, and as soon as the market had a run, it will only go to the 38.2%. So let's take this for an example. Let's take this out. Okay. When the market turned here and then make our first run down, from that top to that bottom, do you see how deep the market retraced? That is very, very common in Elliott wave principle. That the first retracement is a very deep retracement. That is our best place to buy and sell. Is a very deep retracement. It's because it's the first run and then it retraces. As soon as the market had a bit of a run, or the market is quick, then it will only retrace to the 38.2%. And let me give you an example here on the British pound. Let's delete that again, everything. Alright, let's take this example here. Let's take this high. Right. There's a high there. Correct, Ian. Point C. Remember, your start is A. You've got a down move as B, and then it retraces to C. You want to sell C, or you want to sell the 78.6%. Let me go back. I will put it in here. Are you happy with that? If you are in the beginning of a bear market, the market will retrace very deep, and when we are in a bit of a run, when the market is falling fast, the market will only go back to this 38.2%. Here's a very nice example. I've missed this one. I'm glad I saw it now. Look at this run here. When the market came down here, now remember, we don't know what the market is doing. Let's put in a red line. Let's assume that we don't know what the market is doing after this red line. Alright? We only can see up to this red line. We've got a bear market. We saw that something is going on. We want to buy this market. Look how the market is turning bullish, but the retracements are very deep. So let's say this is our A, and let's say it was on a 1 hour chart or a 15-minute chart, I don't know. A and a B, and now we want to buy C. Happy with that? Look how deep C is. Alright, C's are very, very deep when the market turns. That is a 78.6% retracement. That is 78%, or the fib zone. You can see there 78.6%, 78.6%. That's very deep retracements. But as soon as the market rallies, do you see how the market does not come back to the 618% again, or the 786%? The market now only go to the 38.22. So that is my A. Now that is my B. Look at C. Very flat. If you didn't know this previously, you should put your order down here 618%, and everybody missed the trade. But as soon as you know Elliott wave principle, or how Fibonacci works, you know as soon as the market's got a rally, it will only come down to the 38.2%. Alright, so when the market turns, expect deep retracements to the 618%, and as soon as the market rallied, only shallow retracement, because the market is moving. Alright, as soon as the market moves fast, only at the 38.2% retracement. So what I'm looking at the British pound, I'm looking for selling. Remember that in that gold? Let's go back to gold. Do you see how the market already had a bull run? This market has got less chance to go to the 618%. It's more likely only go to the 38.2%. I don't suggest that you guys buy the 618%. Here was the 618%. You see, as the market turned, it came down. So let's test that Fibonacci on the gold. That was my A here at the bottom, my B at the top. We want to buy C, and look here, the market just turned around from the bearish to the bullish. You can see 618%. That's my fib zone. I want to buy here if my indicators tell me this is a good buy. But as soon as the market had a run, and I'm taking that second rally there, it will only go to the 38.2%. So Bogani, that is how I use my Fibonacci. I hope that answers your question. And that is a very nice demand level, Ian. Look again, a long bullish candle, a little bit of a sideways movement, alright, and then again a bullish. This is a rally, a base, and a rally. So that's a very nice demand level there at 125. It is with my 38.2% retracement, and if you can remember, I always use my 200-day moving average. That is also there. I know I put my neck out for you now. If this trade doesn't work, don't be cross with me. Even I, after 12-15 years of trading, have losses. We all have losses. There's no trader that does not have losses. The key here is, guys, like a normal business, remember trading. With a business, you have got income and expenditure. The key to a successful business is to make your income more than your expenditure. Alright, your income must be more than your expenses. It's the same with trading. You can have losses. That is your expenses. But keep your losses to the minimum, and your income or profit that you take out of the market, let that be more than your losses. Then you will go forward with your account. As soon as your business got more expenses than your income, then you've got in trouble. If your losses in trading is more than your profits, you're in trouble. Risk management, money management, I don't do more than 5%. Many guys do 1 and 2%. That's fine. I will also do a 1 and 2% if my account is $10 million or $1 million. But at this stage, I've got a smaller account. I can trade on 5% maximum risk, and I go always for 2 to 2.5, and I'm happy with that. Alright, is that the demand level at 1275? Yes, it is, Ian. That is a demand level. This is a demand level as well. The reason I don't trade this demand level, or I don't like this demand level, you can see this market. Let me put that. Can you see that demand level here? Rally, base, rally. That's a brick breakout. There's a lot of indecision in this market. The buyers and the sellers are fighting. And who won? The bulls won. And again, look here, the market came down to the demand level. It's just testing. I like this one better, and I like this one even better. There's a small demand level there. So again, we don't just buy demand level. We're looking for reason why that level should get some buyers in the market. So there's my first demand level. Obviously we see the head and shoulder pattern here on the neckline. The bulls came up. I think the sellers saw this resistance here and want to take the market down, but the bulls just took over and it broke out. I'm looking for that second one. Why? Because there's Confluence on my 200 doing average and my 38.2%. So there's the three areas that I would like to buy the gold. If you look at Elliott wave principle, you'll also know that this is my fourth position. So Ian, let's look at over the next coming days, the day or two, maybe until Friday. Let's see what gold is doing. Maybe it doesn't come to that level, then I've missed the trade. That is already a demand level there. You can see the market is bouncing off, sideways movement bouncing off. The buyers want to take over there, and maybe the sellers see this as a double top. Let me just quickly do that. The reason I say it's a double top, you can clearly see here, and I know, guys, and you must learn the rules of every pattern. The rule of a double top is that it will go, or the target will be the same as from the neckline to the top. So if that is my top, and you will see there again, the target of the double top comes to my 38.2%, which is the second demand level. That's why I rather will buy here. Yeah, let me show you what supplies and demand levels look like, Ian. There's a lot. I'm gonna show you. I've got one chart here that's not working nicely, so I'm gonna use that as an example. Alright. Let's assume this is candles. We've got a bullish candle, two sideways candles, and then a breakout. So that is my demand level. Why? Bulls came in, a lot of fighting between the bulls and the bears, and the bulls were. So this is my demand level, and I like it as close to the bottom. In other words, this market is coming down. This was a bear market. We had the low here. Then it breaks up. Demand level breaks up again. When the market comes back, I will buy this level. That is a demand level, and obviously the inverse, it's for a supply level. I will go in supply and demand levels. You can also Google Sam Saden's videos. That's very nice in supply and demand levels. It is an indecision in the market where the market is turning from bullish to bearish. We've got a long bearish candle. We've got 2 or 3 candles that is just sideways, and then again it breaks out of the level. That's where most sellers came in. And remember, most of the traders, what will they do here? As soon as they're in the market and they want they're in the profit, they want to put their stops on entry. Most traders do. So there's a lot of stops on that level there, and you want to sell that stops. Alright? That is what basically happening. So if they sold the market there, they've got buy stops. When the market goes up, they can buy. I'm selling. All those buying stops are lying there. They can buy back that. I don't want that. I'm selling that supply level. Market will do this. Go up. Test that level. Take out of all those buying stops, and the market will break down. Alright, so that's basically what is happening here with supply and demand levels. Again, at the bottom, everybody bought. The market is going up. They want to put in the stops. They want to protect their equity, which is no problem with that. So if they bought, all of their selling stops are there. So if they are all putting their selling stops on one level, I want to buy that market. I want to buy all those stops. Market will touch it, liquidate all those orders, and go in the opposite direction. Alright, the difference between demand and supply and resistance and support. You know what supply and resistance and support is, highs and lows. Let me explain what is resistance. If you want to look at the market, if you go up and you get a high, that is resistance. Up and left, that is a resistance. Up and left, that's a resistance. So that is where the market got resistance. That is not supply levels or demand levels. And if you go down and left, you can get your support. So that's a support, that's support, but that's not necessarily a demand level. A demand level is like this one here. There's a nice demand level. So the market broke up, the bulls took control, the sellers tried to turn it around, but look what happened. There's indecision in the market, the bulls break out. So there's a nice demand level. Demand levels usually is just above support levels, and supply levels are usually just below resistance levels. So if you want to remember it like that. There was a double bottom on the... Any questions, guys? Am I going too fast? Am I vague in my presentation? Do you want to do something different? So next week we will do Elliott wave principle. We will go in a little bit more into that. That's advanced trading. I will do the Gartley, the butterfly. In this presentation we only do those forwards. Remember what, where, when and why. What, when, where, why. If you can answer 4 of those questions, then you know in the right trade. Supply and demand we did a bit. Indecision in the market. We did Fibonacci, Bongani. I hope you learned something, that the market will go, when the market turns, will go in deep retracements. like this one here. This is a pound daily. So let's look at this quickly if there's a trade for us here. Right. This is typically how I will analyze the market and what I will do. We've got a bear market here. It's a monthly chart. That trend line doesn't help me a lot. I will go immediately, if nothing is going on here, I will go down to the weekly to see something happening there. This is a bullish market. Why? Because there's higher highs and higher lows, but I see that the market took out that high. There's my trend line there. Alright, this was my previous trend line, but the market from there went sideways. Market make a 3-wave up here, and look at this daily. Now let's working from the top. There's a nice pin bar. Market came down. You can see the divergence. Do you know what divergence is? I'll explain to that here. We use the RSI here. You can also use the MACD, not the stochastic, only the MACD and the RSI will show you divergence. Divergence is when the market makes a new low. You can see there's a low, but there's a lower low. But my indicator at the bottom has got a low and a higher low. Alright, so that is divergence. The market came down, make a lower low, but it didn't happen on my indicator. That's a higher low. That is why the market turned there. There's 2 divergences here. If you get a third one, it's almost every time it's better to have a third divergence. Alright. So that's divergence. The market came down. Obviously, this is my impulse wave. In Elliott wave principle, you'll also see that this is a 5-wave move with divergence at the bottom, and I'm looking for a retracement. So this is my bear market. Retraces, I want to sell this market. My indicators and my candle information, if I can get supply and demand zones, even better. What I also see is this little thing here. That to me is some kind of double bottom. Even it's not equal at the bottom, it's a double bottom. And I know what is the rules of a double bottom. You buy only when the neckline breaks there, and the target is the same from the neck to the head. Alright, you can also use this little tool here. It's better. This other Fibonacci extension. Hello, are you still there? Alright, everybody's there. And you will use the 200 of this baby here. Then you know it is equal to that line there. Alright. Neck to the head. So this double bottom, my target is around that area. So on the 786%. So that's a quite indication. I'm working with a bearish market. I'm looking for the ABC. Ian, let me see you there. That is my A. In other words, the start of my move. The B, it's a bearish market, and I want to sell C. Alright, so that's my ABC. I'm looking at the pound Aussie dollar daily. I've got a 5-wave move down. I've got a double bottom with divergence, and I know the double bottom target is in this area. So let's see how everything fits together if we can find a trade. So that's basically the target of my double bottom. And here is a nice supply level. Why is this a supply level? You can see it's a rally, a base, or an indecision in the market, and the market fell again. So I can mark that as a nice supply level. So I can see that supply level is on the 78.6%, and it is a target of a double bottom that I saw on the daily. Do you see how the three things now come together? I've got the ABC, alright, double bottom target has been met, or is almost met there. I've got a nice supply level, and I'm looking to sell. So what is the only thing now that I must look for more confirmation? I can put in some indicators. So let's put in the stochastic. If that gives me some indication. Alright, so there's nothing basically going on the monthly. It's not looking very good on the weekly, neither on the daily. So I'm a bit skeptic about this trade if I want to sell that. No, I will only sell on that level. I will not start selling if the market doesn't tell me with a candle information. In other words, on that level I would like a pin bar or a shooting star, if you want to call it that, or maybe an evening star, or that nice supply and demand levels that candle information. We've got a long black candle, sideways movement, and a black candle again. I will look at that and maybe sell there. So on the 4 hour it looks a bit better, but this trade I will be looking to sell C. Stops obviously will be above A, and it's a 300 pip stop, so this is a big trade. But remember, if this market turns around at C, it will most probably go down to 1.8, so that's about 1,000 pips against 300 pips, which is not too bad. That's 1 to 3, and obviously I think this market will go down to this trend line again. So let's see what the market is doing. So that is how I analyze the market. I've got more than one reason to sell this. So what did I do? What I want to sell in this market? Yes, because the market made a impulse wave down with divergence and is retracing back. And where do I want to sell? I want to sell it at the target of the double bottom. I want to sell it at the 78.26, which also is a nice supply level. When I will sell it is when I get a candle information or confirmation, and as soon as I enter that market with my stop and I limit, now I know why I entered that market. I'm not the guy that scales in, Ian. I'm the guy that looks with information and enter exactly on that specific price. I just want to show you some global economics. Remember, guys, the Australian Canadian dollar, many guys are selling the following. They are selling this currency now, selling Australian dollar against the Canadian dollar. I don't want to sell it now because we're extremely bullish, and remember that Canada is an exporter of oil. I don't see oil go up again when the Canadian dollar won't fall. So the two will work together. The Canadian dollar is weakening against the US dollar because oil is falling. Oil's price are dropping. So as soon as oil price is dropping, the economy of Canada is getting hit. That is why the Canadian dollar is losing against the the US dollar. The US dollar is gaining against the Canadian dollar. As soon as the oil turns, as soon as oil is going up and increasing in value, you will see the Australian dollar and the Canadian dollar turn around, and they will turn around exactly at the same time, because Canada exports oil. So remember your global economics. You can go look on the market of fx3.com. There's all the fundamentals are there, but you must understand that Canadian dollar is connected to the oil price. Alright? And even if you go look to the European fundamentals, that is why the euro is just weakening. It started when they did quantitative easing. They are printing money, they're buying stuff with their money, they're just throwing money. As soon as you throw money into the economy, you are weakening the currency, and they like it at the moment. Alright, so remember your global economics. Go look on the news, what is happening. Yes, the charts will tell us where we can buy and sell, but remember there's fundamentals also that you must remember. Okay? I want to do the triangle quickly and how it works with a relative strength indicator. Relative strength index, that shows you the strength of a rally or the strength when the market comes down. So what happens in a triangle? In a triangle, the price contracts. In other words, your cycles or your waves are getting smaller and smaller. The strength is weakening. That must also show on your indicator. So let's test that. Let's put in a line there, and let's put in a line there. Can you see that high? Is that high there? That low? Is that low? That high again? That stayed in this little box here at the bottom. That shows me this is a true triangle. The price are staying in the box of the relative strength indicators. My triangle is contracting with price. When did this triangle broke out? At that point there, and that point there. How do I trade a triangle? We know it is a trend continuation pattern. Usually got 5 legs in a triangle. 1, 2, 3, 4, 5. We know we are selling at because we're in a trend continuation pattern. We came from a bearish market. Let's make it a thick one. We're in a bearish market. We had a triangle. We know that the market again will turn bearish. What is the rules of a triangle? A leg into the triangle is equal the leg out of the triangle. That comes down at 1,240 on the euro. Here we've got a bullish market. We put in our Fibonacci's. You'll see it's very close to that 78.6%. We're already in the fib zone on the euro. I don't like to buy this market just yet because we are very, very bearish. We've got strong candles. But look again here. On your left side, we've got a strong bullish run. We've got a sideways movement or a base. Strong bullish run again. So that is my demand level. Guys, there's a lot of demand here in that level there. And it is on the 78.6% retracement of my Fibonacci's. Also the target of my triangle. Everything is coming together here. I will look for this market to fall over the coming few months or weeks to a 78.6%, and then maybe if I get a candle information on this little supply zone here, or demand level here, demand level here at the bottom, I will buy this market. Let's put in our indicator to see if that gives us something. Look at that. My stochastics are very low. Looking at the weekly, again, very, very low. So this is setting up over the coming few weeks to buy the euro here at the bottom. There's a few levels that it must go through, few support levels. There's a support level at 107.43. Maybe that holds up. I don't know. I won't look at the euro to sell it, to buy at the moment. Not at all at this stage. I will rather sell at this level here. Look at that supply level there. Demand supply level there. There's a supply level. We're in a bearish market. I will look to sell there at 115 rather sell at 115. We're in the direction of the trend, selling a supply level, and we want to ride it down. There's a lot of space down here, and that's how I look at my analysis. Stochastics are lining up. It's coming out on the 4 hour. The stochastics are coming out of the 20 zone, but I will not buy this market with a bearish one. We know that the fundamentals are bearish for the European countries. You can't buy this market. Anything else? Go to SA Trader Lounge. If you still don't understand what I'm talking, go for a live seminar, free first class. Go book Slanga, Santon. You can book your classes. If you still don't understand Bongani, I did Fibonacci. Is there anything that you did want to know about Fibonacci? Ian, you're mostly on supply and demand levels, I think. Anybody else? Dion? English or Afrikaans? C4? Kolo? Is there anything that you guys want to know? If it's indicators, if it's Fibonacci. I will do that gladly. Okay guys, what did we do tonight? The 4 things, I'm just recapping quickly before we go. What, why, where and why. If you can't answer that in a trade, then you don't trade. If you can't handle the money management, the risk that you want to take on that trade, you leave that trade. There's specific places that you must put your stop. We did supply and demand levels, that it's not support and resistance. We did specifically look at how it looks in the market, where you can buy and where you sell. We did a little bit of Fibonacci. We know that the market, if the market turns, it will make a deep retracement as our second wave. And as soon as the market runs, it will make shallow retracement. Even this is an example why. Look at that shallow retracement there. And you've got no more questions, then I will log off in about 5 minutes time. You've got 5 minutes guys if you want to know anything. Do you want to know a specific market? I will post some trades on SA Trader Lounge on Facebook. I will put more of my charts there. I will post most of my trades there, that you guys know what we are doing, and that you are more in touch where do you want to buy or sell, what are we looking at, and I will explain by a chart and with some comments with why I'm selling and why I'm buying. This is the Australian dollar against the New Zealand dollar. I'm just looking at this chart quickly, what it's doing here. You can see this as maybe a supply level. This is a tweezer top. It's almost like an evening star kind of look. I think the market will go down from here. This is actually not a bad trade, but I can see the market is turning, it's making bullish. So I'll rather buy here down at 1.05. I will look to buy here down. This market is turning bullish. Alright, the market is going up. I'm looking for a leg down, maybe to buy here at the bottom, but I'll show you. Dion, is 'n plesier. Ja, Afrikaans is a pleasure. How long have you been in trading? Do you know anything? Have you seen anything? Must I do something for you? So that's the key. You look at the ABC, in other words, you look at the impulse wave with a retracement, and you want to buy or sell in the fib zone if it is confluencing with a demand or a supply level, maybe a moving average, and if your indicators show you that there's divergence, you can buy and sell. Remember, in a bullish market, we want to buy on the Fibonacci's. We want to buy on a trend line that's going up. Let's test this. Where did this market turn? From the top to the bottom. Look here, the market had already run, only came down to the 38.2%. Again here at this one, if that was my low, this is my, look how the market came down to the 618. So the first time it will go down to the 618%, you can buy it, but as soon as the market makes a higher high, it will only go down to the 38.2%. That's a little trick. Yeah, Dion, it's a difficult thing to do. It's a very disciplined art. I still see trading as an art. The thing that people do, mostly traders, they want to predict turns in the market. It doesn't work like this. Your brain doesn't tell you to buy the market here, because your brain tells you that this is a high, it can't go higher because it isn't at the top of the screen. Believe me, this market, this is a 4-hour chart. If you go down to a weekly, you can see this market still got a lot of space to work with. This market can still go up. But because our brains work like this is the top of the screen, we know our brains can't comprehend that. But the rules of trading states that if I've got an upwards movement, it bounces on this Fibonacci, I must buy this market. And I then look at the weekly, then I know that the market turned, came down to the trend line. We're still at the beginning of maybe a bullish market, then I buy. Obviously I will look at some sort of confirmation of a candle information or something there. Alright guys, we're going to do this every Monday at 7 o'clock. We're going to do different things. I will go in more advanced trading with Elliott wave principle. I will do a whole series, but please go look at the YouTube channel. I did a few lessons there on RSI and stochastics. I did one on the King's Crown, the difference between the King's Crown and the head and shoulders, the rules to apply, and go look at the rules. Yeah, we will do Elliott, and remember the rules of every pattern. That's where there are rules. Double tops and bottoms, you know where you enter at the neckline only. Same with the head and shoulder pattern. It is only the King's Crown that you can enter on the right shoulder. Either it's a buy or a sell. There's specific rules for specific patterns in the market. Alright, thanks very much everybody. I appreciate it. It's Honor Global Forex Institute. We are starting in Cape Town soon. I'm the trainer down here, and I'm starting with this webinars every Monday night 7 o'clock. Go look at the price patterns. Go get your questions. I'm on SA Trader Lounge every day. I will answer questions there. I will post my charts. I will post my trades, and see what's happening. So I'm looking at to buy some gold down that 1,250. I think I made that price. Euro is still going down, but let's see. I will update on the SA Trader Lounge channel. Thank you very much everybody. Have a good week. Bye bye.